I quickly want to talk about one of the easiest way for you to blow up your Forex account. When you first come into Forex, one of the most catching thing is you want to make a quick buck. You just want to make that money so that you can buy that house, whatever your goal may be. And most people put that first. They put how much they are going to make from Forex ahead of how much they are going to lose. They don't think about how much they are going to lose. And they come in and they make all the mistakes, and before you know it, they blow up their account, and the next thing they are accusing their broker of cheating and all that. But there are little things which you ought to have known before you open a live trading account. So quickly, I want us to go through one of the few things that can cause you to be a failure in the Forex market. Most people have lost so much money that they cannot recover that amount of money from Forex. So what are the things that you need to avoid in order not to blow up your account? So quickly, I want to introduce you to margin. Margin trading gives you the ability to enter into positions larger than your account balance. With a little bit of cash, you can open a much bigger trade in the Forex market. And then with just a small change in price moving in your favor, you have the possibility of ending up with massively huge profit. But for most new traders, because they usually don't know what they are doing, that's not what usually happens. More likely, price does move, but it moves against them. So what are we saying here? If you look at this chart critically, you can see from this region, you can see this bearish close, and all of a sudden, imagine if you enter the trade at this point. You can see 1, 2, 3 bearish candle closes. You enter the trade thinking that price is going to head downward. You enter a trade at this point thinking that price is going to head downward. Then after your entry, price moves against you. It also moves even higher against you. But because you have placed so much trade, and your account cannot handle it because you want to make a quick buck. Let's say your account is just 1,000 naira, and you have used up your margin. Before you know it, it goes against you, and you end up blowing up your account. So what are we saying here? As a new trader, the mistake that most new traders make is that, okay, they have identified this. Let's say the trade is around this zone, just right here. They want to enter this trade around this zone. You can see right here. They have seen that this is an uptrend. Then price has rallied up to this point, and they have seen this bearish candle close. So because of that, they think price is heading downward, and they sell at this point. Immediately they open up this. You can see this bullish close now. So they sell around here, but after selling, price now rallied against them because they do not know how margin works, and they have placed so much money thinking that they are going to win on this trade. You can see after they have entered the trade, price rallied up, and at this point, even here is not that worse. After that, you can see these two bearish candle close. Then you see this bullish close, another bullish close, this indecision, another indecision, then this spike up. By the time price gets to this place, at this time the alarm bell will be sounding, And because they have used so much margin, they will end up blowing up their account at this point. But you can see, eventually, price moved in their direction. Had they not used up so much margin, they would have been in for a nice profit. You can see, price actually moved in their direction. This ought to be their profit. But because of misuse of margin, they ended up blowing their account at this point. Blowing up your account is one of the most painful things that has happened to me. I've blown up my account before, and this is why I want you to pay more attention. So before you open a live account, maybe you are still trading demo, or maybe you have a live account now and you have not blown up your account. The question you should ask yourself is, do you know what margin actually is? What about used margin? What is free margin? What is margin level? What is a margin call? What is a stop out, or a margin closeout? So you need answers to all of this. These are all margin jargons. A change in one of these causes a change in another. Equity, balance, used margin, free margin, unrealized profit and loss, and margin level. They are all interconnected, as you can see. They are all connected. What does account balance mean? Account balance simply means the amount of risk capital you funded your new account with, which is the cash you can afford to lose. When we talk about account balance, when you open a live account, you'll be requested to fund your account. After funding your account, the balance you have is your account balance, and it should be the money you can afford to risk. You shouldn't fund your Forex account with your children's school fee. You shouldn't fund your Forex account with your rent, or with loan, or money that somebody has asked you to keep for them. So it should be money that you can afford to lose, not money that you can't afford to lose, because the weight of that will keep you down. How can the balance change? Balance will only change if when you add more fund to your account, when you close a position, when you keep a position open overnight and either receive or pay swap or roll over fee. If you have an open trade just like this, your balance can either change when you close at this now. As this trade is, you can see price has rallied against the open position. So this is a losing trade as it is. It's not a loose trade yet, but as it is, you can see it's down by 1,334.08. As it is now, if I decide to close this trade, it means I have accepted to lose this amount, this 1334.08. But if market opens and price heads downward, then it will all become a profit for me. So my account balance can only change if this stop loss that you are seeing here, gets hit, or I set a target around here and price hits the target, or swap. When you have trades running overnight, you get to pay swap. Sometimes the swap is positive, sometimes the swap is negative. And as you can see here, you can see swap. Look at the swap. You are having a 36 cents. You can see this is the swap. So this is a negative swap. So as it is now, this has been deducted out of my account. So these are the only times when your account balance can change if you do the right thing. Unrealized profits and loss. It refers to the profits or loss held in your current open position. This is equal to the profit or loss that would be realized if all your open positions were closed immediately. Also known as floating profit or loss, because the value is constantly changing since your positions are still open. This is the unrealized profit and loss. You can see it here. It is 1334.08. This is unrealized as it is. Because the trade is still active, it might go this way and it will be a loss trade. And it can head southward this way and it becomes a successful trade. So this is an unrealized profit or loss. So that brings us to margin. When trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital is also known as the margin. Margin is simply a portion of your funds that your Forex broker set aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. As you can see from this open position, you can see the balance, you can see the equity, you can see the margin, you can see the free margin, you can see the margin level. Okay, let's quickly go to used margin. Used margin is the total amount of margin currently being used to maintain all open position. Let's say we have two positions open. We have USD yen position with the margin being 400, and we have a USD Swiss franc position open with the margin being $300. So our used margin now becomes USD yen position plus USD Swiss franc position. The total of it, which is $400 plus $300, becomes $700. As you can see here, the margin is 5,448.11 cents. So this is the margin. This is the used margin. Quickly, let's talk about equity. So let's talk equity. The account equity, or simply equity, represents the current value of the trading account. Equity is the current value of the account and fluctuates with every tick when looking at your trading platform on your screen. It's the sum of your account balance and all floating unrealized profits or losses associated with your open position. So if you look at it here, you can see the equity here is $8,719.33. So if this market is open, I'm doing this on Saturday morning, so the market is closed as it is now. But if the market is open, you see that this number will constantly be changing, because you see in the Forex market, the market don't just come down with a bearish candle or go up with a bullish candle. It ticks, it goes up, down, up, down, up, down, up, down, and like that it keeps climbing. So as it keeps changing, so does the margin. The margin also changes as it ticks up and down. We also have free margin. So what is free margin? Free margin can be classified as either used or free. Free margin is also known as usable margin because it is margin that you can use, is usable. Free margin can be thought of as two things: the amount available to open new positions, or the amount that existing position can move against you before you receive a margin call or stop out. We have a free margin here, which is 3,271.23 cents. So this amount covers for all these trades that are open. You can see I have open trade here, Euro, Aussie, a sell position. I have sell positions, and you can see. So this is the amount. This is the free margin for all my open positions, as you can see. So this helps this trade to be opened. Without this trade cannot be opened. And with this, since I have free margins, I can still open more positions. We go to margin level. The margin level is the percentage value based on the amount of equity versus used margin. Margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade. The lower the margin level, the less free margin available to trade, which could result in something very bad, like a margin call or a stop out, which will be discussed later. We have the margin level here. Let's go into the margin call. We are approaching the red zone now. What is the margin call? In forex trading, the margin call level is when the margin level has reached a specific level or threshold. When this threshold is reached, you are in danger of the possibility of having some or all of your positions possibly closed or liquidated. The margin level is the metric, and the margin call level is a specific value of the metric, which is the margin level. As this trade is now, before I can receive a margin call, this amount that is negative, it has to be very, very close to it. So as this amount rises, balance reduces. It will be showing in the equity. Free margin will be reduced, and margin level will also, which is expressed in percentage, will also be decreasing. As that happens, the whole of this place will be showing red. You'll be seeing red signal, you'll be receiving alerts, and at that point, you will not be yourself. At that point, you'll be praying to whatever you believe in for it not to occur. Because anything worse than that, you are losing your entire account. You are blowing up your entire account. Let's go to stop out. The stop out level is similar to margin call level, which I have talked about, except that it's much more worse. Stop out is much more worse than margin. A margin call is a warning of what is about to happen. A margin call is when it has already happened. In forex trading, a stop out level is when your margin level falls to a specific percentage level in which one or all of your open positions are closed automatically by your forex broker. The liquidation happens because the trading account can no longer support the open position due to lack of margin. So, like I've explained previously, when a stop out occurs, it shows that your trading balance can no longer handle the trade. You have over traded, you have over leveraged your account. By the way, there is a video coming on leverage. So you have placed so much weight on your account by over trading, and because trade went against you, you can see just this way, because trade went against you, though stop loss is still far ahead. You can see where the stop loss is. Stop loss has not yet been hit, but because you do not take proper trade management, you can see, look at where the stop loss is, look at where the trade currently is. Your stop loss has not been hit, but because you have placed so much trade, you can see so many trades. All this for your emphasis, all this to lay emphasis on what over trading is. So you can see just this move against you, because you thought, because you've seen a bearish close, another bearish close, you enter this trade here, and after that trade goes in your direction a bit before reversing and coming this way. So as it is now, this trade may finally go and hit the stop loss, or as it's showing here, you can see this bearish close, another bearish close, another bearish close. It can come this way and hit maybe your targets here, or even come much more downward. But because the level of your loss here has outweighed your account balance, you get stopped out, and the whole of this trade like this will just close. At that point that you got stopped out, you have eventually blown up your account. And who knows how you struggle to get that money. Before you open a live account, you need to know the little things that can affect your trading. The little things that can affect your trading success.